Good afternoon. This is Bob Iaccino coming to you from the CME Group trading floor in Chicago, talking WTI crude oil futures in the energy sector. Rally resumes in crude oil. Crude oil is up 1.6% in the last couple of days. Big chunk of that today, up over 1.25% today, well above 64.50, getting to 64.68 on the highs. But after the first down week in the last 6, we get a resumption of the rally, both yesterday and today. Again, yesterday being a small rally, today a little bit of acceleration there. Let's talk about oil fundamentals. The beginning of the rally, of course, started with the comments out of OPEC and Russia over the weekend that basically stated that the oil market is not rebalanced yet, but it's well on its way. So they sort of affirmed their production cuts lasting through 2018 and even brought up the subject of 2019. Again, Alexander Novak, the Russian energy minister, stated that the oil market has not rebalanced yet, but it was rebalancing. So in terms of the fundamentals, we're bearish in the long term simply because the amount of production in the U.S., which is likely to get over 11 million barrels a day in 2018 and potentially take over the #1 spot of global oil producers. But short term, they're still bullish. Demand is there and growing, and overall the production has not outstripped that demand. And again, with the production cuts of OPEC and the non-OPEC nations, we're starting to see some of these draws, repeated draws in the EIA and the API figures without the idea that there's going to be any quick resumption of crude oil inventory. So overall, oil fundamentals are bearish long term, but bullish short term, and we could see this upward channel that we're in continue to climb higher and higher till WTI gets well above $65. Now, rig counts on Friday were down again, down about 5 rigs in the crude oil patch, but rig counts are kind of losing their influence over price, and there's a reason for that. To drill a new rig is expensive in the fracking space. It's not a cheap proposition. There's CapEx that has to go into it. What frackers are doing now to get this production up is they're drilling longer laterals than the existing rigs they have. So that actually means more use of equipment, but not necessarily more rigs. So one of the things that might be a little bit better of a precursor of whether oil production is going to increase or decrease in the U.S. is some of these stocks that produce the oil equipment, and more specifically the fracking sand. U.S. Silica is one of these. But the rig counts seems to be, at least in the short term, losing its effect over price, as again we saw a rig count fall on Friday. The whole rig count sort of patterns leveled off, even dipped ever so slightly, but we haven't seen prices fall off of that. And again, that's because of a more efficient use of existing rigs. So crude oil continues to rally at the upper end of this upward sloping channel. This is Bob Iaccino talking crude oil futures from the CME Group trading floor in Chicago.